In this video, we're going to go over the entire home buying process, and it is a long one, I know, but if you watch the whole video, I promise you, you will be a pro at buying a house. We're also going to talk about what you need to qualify a mortgage and the most common types of loans, and then what happens during inspections, what kind of inspections can you do, the appraisal, and everything else. Hi, my name is Fernando. I'm a local real estate agent here in Atlanta, and our team has helped hundreds of families move in the last 8 years. If you want to get in touch with us, the link is in the description of this video, or just call the number that's on the screen. All right, let's go ahead and get started. So what are the benefits of buying a home? There's mainly three, to be honest with you. These are the three most common ones, but the first one is wealth building. Real estate is something you can hand down to generations, and equity, you can build equity over time. So that's number one. Number two, stability. If you own a home, compared to renting, you're pretty stable. This is your house, so you're not really moving as much. Also, it gives you the flexibility. It is your house. You can customize it and do whatever you want. I know when you're renting, you really can't do much, but when you own the home, if you want to paint the house, yellow, whatever you want to do, it is your home, so you're able to do. So those are the most common benefits about home ownership. And now we're going to go into the sauce. We're going to go ahead and talk about everything. So first, before we do go over everything, we're going to understand the home buying process, because if we understand the home buying process, everything else is going to make sense, right? So what is the first thing in the home ownership, you can say, journey, is deciding to buy. That is number one. So first, you need to decide if you're going to rent or if you're going to buy. Once you make the decision, the very next thing you got to do is getting pre-approved. What does that mean and what does that look like? We're going to get into it in a little bit, but just to kind of give you an overview, it is basically applying for a mortgage, and the bank is going to pre-approve you and tell you, okay, based on the information you gave us on your income and your credit and the amount of debt you're carrying, you are able to purchase, or we are able to lend you this amount of money, right? So that's what the pre-approval process does. And that's a very important process that a lot of people skip, because the pre-approval process kind of gives you a budget. It tells you exactly how much you can buy. And that's something you don't want to do early on, like not do actually, is because a lot of people start looking at homes and get into homes, go to open houses, they fall in love with the house, and then when they get pre-approved, they find out that they actually don't qualify. So we definitely don't want to do that. Okay, next is the buyer broker engagement. And what does that look like, right? That is basically you hiring an agent to help you with the process. A lot of folks do that before getting pre-approved, and other folks go and get pre-approved first and do that. Honestly, you can, step 2 and 3 are kind of the same. But this is where you're going to sign a commitment with an agent, and that agent's going to be your realtor from that point forward. We're also going to talk about later on in the video, what are you signing, what does that does, right? What is that engagement kind of tell? We're going to go over the main details. After that, once you have an agent and you've been pre-approved, then you're going to start the home search. That is the very next step, starting the home search. And then this is basically where you sit down with your agent, and then you figure out exactly where you want to be. You want to do your research. You want to, look at the houses. You're going to basically go see a whole bunch of homes, right? Once you have done your home search and you've basically identified a property that you like, you're going to do what's called make an offer, right? You're going to basically submit an offer. You're going to say, Mr. Seller, I love your house. I want to purchase it. And you're going to get with your agent. And that person, the agent's going to go ahead and write a contract. You're going to go over all the terms. And then I'm going to make a different video about basically writing a winning offer, right? And how do you do that? And that video is going to be very helpful, because I'm going to go over in detail on what it goes in the offer. But this video is specifically just to kind of educate you on the process of home purchasing and the main things that you need to know. So making an offer is the next step. And once you make an offer, what happens is the seller will either accept it or reject it. And if they accept the offer, obviously that means that they've accepted your offer, which means that you're under contract or you're in escrow in other states, which also means that there's an agreement that both the buyer and the seller have agreed to purchase or sell this piece of property, right? And then the very first thing that usually happens right after that is a home inspection. And this is a part where a lot of people get discouraged, and I'm going to educate you a little bit, and we're going to stop right here because there's a lot of misinformation in regards to home inspections. So as a buyer, the way, if you write your contract properly, you should have a time what's called a due diligence period or inspection period. And then during this time, you're able to do any kind of inspections on a home. You can hire a third-party company to come in and just check the house for you, right? That an inspection company. There's hundreds of them. I would say talk to your real estate agent to see which ones they recommend. If they used before that, or if you have one yourself, you can also just pick whoever you want to do. A lot of folks, especially first-time home buyers, they want to save the money because it can get pricey depending on the kind of inspections you do on a home, and they decide to do just hire a family member, and which you can. Doesn't mean you have to use a third party, but we always recommend just getting a professional inspection company. They do that every day. They do it all the time, and they know what they're looking for, right? And I will tell you, disclosure: not all inspection companies are the same. And then also, this two different inspectors can inspect the house, and they both can get different results. That is just how it is, right? But when it comes to inspections, you can do a regular home inspection, and we're gonna go over the pricing or how much it costs later in this video. But you can do like a regular inspection. You can do a sewer scope. You can do a lead paint inspection to make sure there's any lead in the house. Also, you can do a termite inspection. You can get the roof inspected, the HVAC inspected. There's just so many inspections you can do, and depending on what you want to do, like if the house has a swimming pool, you can get that inspected as well. There are so many things. You can even do a soil test. During this period, basically, you should check the house for everything, because once you purchase the house, whatever issues the house has and it comes with, that is your home and that is your problem now. So, and then also during this time, it is a great time for you to drive in the neighborhood, basically drive in the morning, drive at night, possibly even talk to the neighbors about living there. You can always knock on the door. Just basically you want to do your homework and make sure that you want to purchase this property. Because typically, this is the only time in the contract you will have to terminate for any reason during this inspection. So, what happens after you get the report, which is the very next thing right here, which is negotiating repairs. So the report, they're going to be long, by the way. So when you see the inspection reports, they're going to be extremely long. And don't freak out, all of them are like that. Some of them are longer than others, but they're going to be over 30 pages long. It doesn't mean that the house is bad. What you're going to do, you and your agent are going to get together and going to go through basically everything that is important for you. I do not recommend just asking for everything because every house, doesn't matter if it's new, it's not going to be perfect. They're all hand built. They're made by humans. So there are going to be things that are important or not, and you just have to pick those things that are important to you. What do I mean by that? So if a switch not working or something like that is important to you and you're not very handy, or you don't know an electrician that can fix that for you at a very low cost, then yes, I would say ask for that. Also, like if the roof is old and it needs to be replaced, go ahead and ask if the seller can replace it. And if the seller is not willing to replace it or something like that, then you start negotiating, the price down, or they pay closing costs, which is, we're going to get into what closing costs are basically. And it's just another expense, and that's going to be later in the video. But you can get into just the negotiation part, right? Something else that can happen during the inspection period is that the seller may just say, no, I don't want to fix anything. You're going to buy the house the way it is. And that has happened before, and you can literally just walk away, terminate the contract, and move forward, right? Because I would tell you this, a lot of these houses look all put together and they look well, right? But once somebody goes in deep and starts looking at it, yeah, there can be problems with the house. And like I told you before, if you purchase the home and it comes with an issue, that becomes your issue after you sign the property. So during this time, it's a great time to negotiate repairs, get quotes from different contractors, and what's going to happen is there's going to be some type of agreement the majority of the time, and that can look like the first way it can look like is the seller's going to agree to 7 or the 10 items you requested, right? Or the seller might say, you know what, I don't want to fix anything. What if I give you an example, $7,000 in credits in closing costs, and you can just use that money to fix the house yourself. That is another way. Or you can just decide to terminate because you didn't like what you saw, right? But there are many, many different inspections you can do, and not everything on there is, it's going to be massive. You literally want to negotiate the biggest ticket items like the roof, the HVAC, electrical, plumbing, stuff that is just expensive to fix. You definitely want to negotiate that. So after you pass that period, you're gonna have to do an appraisal on the home. What is an appraisal? It's technically just the bank is gonna hire a third party to come out and just put a value on the property. And what is that, right? The bank is just basically saying, is the property worth what you're paying for it, right? Is it worth the $500,000 that you're paying for it? And then during the appraisal, a lot of things can happen. The appraiser may come back and say, you know what, the house is not worth 500,000. It's actually worth 485. What do you do in that case, right? You have different options. Option number one is you just negotiate the price down. You go to the seller and say, Mr. Seller, you know what? The appraisal on this house is low. The house is worth 485 according to the appraiser. Can you reduce the price? Then the homeowner might come back and say, no, I don't want to reduce anything. What are your options there? Number one, you can always cover the gap and then just buy the house, pay the additional $15,000. Option number two is what usually happens most of the time is you kind of negotiate something. Maybe you don't buy the house at 485, but you buy it at like, I don't know, 493 or something like that. You kind of both meet in the middle somewhere, which is what usually happens a lot of the times, the majority of the time actually. And then there's the, okay, it didn't appraise, I don't have the money, I don't want to cover it, or I don't feel comfortable buying a house that's worth less than what I'm paying for it. You can just terminate the contract if you have an appraisal contingency. So that's usually the outcome. And what is the outcome if the property is worth more than I'm paying for it right now, which is actually very common in the market that we're in right now? Nothing. It just means that you're getting a good deal on a home. You can technically, if you want to, increase the sales price to absorb some of the purchasing costs, which is closing costs. And we'll go over that in a little bit as well as far as the expenses. But that's usually the home buying process, right? You do the inspections, you negotiate repairs, and you do the appraisal. And then typically what happens is you get a loan approval. It's typically a loan conditional approval. If you're working with a good lender, sometimes they do this before you even start looking for a home. They get you conditionally approved, which means that the bank has a commitment to give you the money, right? They've already checked all the paperwork. They check your credit, your financials. They verify the funds. Everything's good, and the bank is saying, yes, we're going to go ahead and give you this loan. So remember, you got pre-approved first, which is the bank saying, I think we can give you a loan based on the information that we give you. The loan approval is we are going to be able to give you a loan. And again, depending on the lender you work with, you can get that done prior to searching a house, which makes negotiations a lot easier because you can close super quick. And what is a conditionally approved loan, right? That just means the bank has a list of things that will say, I'm going to give you the loan if you do X, Y, and Z. And it's typically just providing documentation for things. It's nothing crazy most of the time. But once you have a loan approval, that means you are getting a loan. Then after that, you will get what's called a clear to close. This is all during the loan approval process, which means that the loan is done, we're ready to close. So after you get that, you're going to do what's called a final walkthrough, which is very important. And trust me, I got some stories. Maybe I'm not going to talk about them in this video, but I would tell you the final walkthrough is very important because this is the last time you get to look at the house before you buy it. And you definitely want to walk the entire house. You want to open all the faucets. And you typically do this the day before, the same or a few hours before closing. And this is where you go and just check the house, right? Make sure that you're buying the house that we all agree that you were buying. This is also a great time to check everything. You know, like I said, open the faucets, make sure nothing's leaking, make sure nothing's missing. So if you negotiated in the contract that the refrigerator was going to stay, make sure that is there. If something is missing during the final walkthrough, you still have an opportunity to go back to the seller and say, Mr. Seller, you took the refrigerator. The refrigerator is part of the contract. Please bring it back. If you don't bring it back, what can we do here, right? And typically you could delay closing, which is the next thing. So if everything's well, we're going to go ahead and go to the next thing, which is the closing, right? But if something is wrong during the final walkthrough, which it's happened to me before, I had somebody breaking into a house before we closed and they stole a bunch of stuff. And what happened is the seller went back and fixed it and closing happened and we just got delayed, which is the closing, right? The closing is the day that you and the seller finalize the contract. This is exactly when you sign for it It is when you basically own the house. That's when you become the owner of the home. At that point, the house is yours, and then you do what you do. You move into the home, which is the next step. So that is kind of like a understanding of what the home buying process will look like. And I'm doing this because it is important to understand the process before you go through everything else, so you can do everything in the order that you're supposed to do. Next thing we're going to do is talk about getting pre-approved and what are the requirements. They're actually very simple. Number one, your credit score should be above 580, and that is to get like an FHA loan, right? 640 is where you want to be or higher. Over 700 is preferred. If you have a scored over 700, you can pretty much qualify for all the loans, programs, conventional, FHA, and we'll talk about those in a little bit. Uh, Another thing too is full-time employment, where is either W-2 or 1099. 1099 just means self-employed, and you have to usually be self-employed for 2 years or more. Basically, have filed your taxes as 1099 for the last 2 years. There are exceptions to that rule. You can get a 1099 loan. Basically, 1 year you just have to make higher down payments, and then also assets. You need to have enough money to buy the house. You need to have your down payment or closing costs. There are different programs, especially if it's your first time, where you can get assistance on the down payment and closing costs, and we'll go over that in a little bit. Also, the debt to income ratio should be about 40 to 55%. It just depends on the loan that you're trying to get. What that means is, like, if you make $100, your debt to income ratio, basically the bank is gonna just take 40% of that and qualify you based on your mortgage, right, or 55 depending on the loan that you get. So those are the requirements. They're very simple, and by doing that, they just run your credit. They check with your employer. If you're self-employed, you gotta submit your taxes or your W-2s. If you are W-2 employee, they were going to probably require bank statements to prove and show where this money that you're using to purchase the house from. And then again, based on how much money you make and how much debt you're carrying, that's how they're going to approve you for that amount. That's where you get I got approved for 500,000, 600,000. That's basically that. All right, now we're going to talk about the different types of loans, and we're going to talk about very common loan, which is an FHA loan, it literally just means a Federal Housing Administration loan. This is usually best for first-time home buyers or people with lower credit. This loan typically has a down payment at 3.5%, and the minimum score for 3.5% is 580. If you have a credit score around 500 to 580, if you put 10% down, you will get an FHA loan. What are the pros about this one? It's easier to qualify than a conventional loan, which is the one we're going to go over next. It requires a lower down payment. What are the cons? It does require mortgage insurance, and we're going to talk about mortgage insurance in a little bit. And then also it has a limit as of the recording of this video at $688,850, which means that is the maximum loan limit. That is as high as the loan will go. Could you purchase an $800,000 house with a FHA loan? Yes, you can, but you're going to have to cover the gap between 688 and 800. But most people who are using an FHA loan are in the city of Atlanta are going to purchase a home under 688. And it's a very common loan for first-time home buyers and people with low credit scores. And we're going to go into now and talk about a conventional mortgage, which is the most common, is literally the one that is used the most. And this one is really good if you have really good credit and solid financial history. Your down payment, if it's your first time, will be between 3% and 5%. A lot of people put 20% down to save what's called private mortgage insurance, and we'll talk about that in a little bit and go deeper into that. But yes, the first-time home buyers, there's conventional loans can be 3% down. It's actually less down than an FHA loan. Your credit score should be above 620. 640 is what most lenders prefer. Sometimes some of them will require a 660. But if you have over 700 scores, you're most likely probably going to go the conventional route, because it is a loan that it's a lot easier. I don't want to say there's just less guidelines to it than an FHA loan. There's a little bit more requirements or things you got to do with FHA. But conventional, That's why it's the most common, because it's a very simple loan. So what are the pros? Lower rates. With the higher your score, the lower rate you're gonna get. Also, there's no private mortgage insurance if you're putting 20% down. What does that mean? Is basically, if you put $20,000 for every 100,000, you're not gonna have private mortgage insurance. Like, it's not required with FHA. Even if you put 20% down, you're still gonna have that. Also, what are the cons? It's a little bit more stricter, I would say, as far as income requirements. They just let you borrow less money with the same income. The FHA route, they typically let you borrow more money with less income. And that is kind of a con. The other one is, if you PMI is required, private mortgage insurance is required if you're putting less than 20% down. But the awesome part about conventional, as the recording of this video, the loan limit is $106,500. So you can technically buy $1 million house with a conventional loan if you put 20% down. So this is the highest loan limit you're gonna have. And then again, we're kind of briefly going over all the loan types, the most common ones actually. But that is conventional financing. Again, I can talk about these things forever, but I'm just kind of give you a breakdown of what those are, the pros and the cons, and all that. Also, there's another one called VA loan. This is typically best for active military veterans and their spouses as well. So this loan is pretty awesome because it's a benefit, to those people, because they can put 100. I mean, it's 100% financing, which means there's no down payment, and the credit score. I mean, it can be between 580, 620, and it varies by lender. But I mean, typically, if you have a low score, like, you will get a VA loan. So what are the pros of VA loans? No down payment or private mortgage insurance. Those are awesome. So if you're active military or a veteran, or if you're a spouse of one, go ahead and look into a VA loan, because they're very, very, very good. Also, competitive rates. The interest rates are very, very competitive. And then they have more flexible underwriting. So I just actually did one. I represented the seller, and then the buyer was doing a VA loan. The loan officer had set up this program where they were helping them getting into a house, which is pretty awesome. So it has very flexible underwriting. So what are the cons? Their VA loans do have a funding fee. Sometimes can be rolled into the loan. It has to be a primary, residence only, so no investment properties. I forgot to mention, with conventional, you can buy investment properties. Typically, you have to put 20% down. The loan limit right now is like 806,500, but honestly, I was just told that there's literally no ceiling to it, but it varies by lender. But again, you can get a VA loan. Another one that is very common is a USDA loan. This is typically for like rural areas, suburban areas, so like out in the country, basically. So if you live out in the country, and there's a different websites you can look into, and you can kind of see if a house qualifies for a USDA loan. It's very similar terms, not really, but kind of. If I had to compare it to another loan, it can be kind of like a weird version of a VA loan, but it's not really a VA loan. Why? Because it's 0% down, and the credit score usually needs to be above 640. There's no down payment requirement, and then lower private mortgage insurance costs, even lower than FHA loans on USDA loans. Those are pretty awesome. I've actually done a couple of them in my career, and again, this is a perfect loan if you're out in the country, because you don't have to put pretty much any money down, especially if the seller helps you pay for closing costs. You spend hardly any money. What are the cons? Not every house qualifies. It is by area. So some areas will qualify, some other areas will not. There's definitely income limits. Like, if you make too much money, you're not going to be able to get it. And then the loan limits vary by county. So that is another thing with USDA loans. The loan limits are different depending on where you buy. So next in line, we have jumbo loans. These are if you're balling out of control and you ever wonder how people are buying, $3, $4, $10 million houses, this is it. This is a jumbo loan. The loan limit on these has to be over the conventional limit. So if you're buying a $1.5 million house and you're putting 20% down or even 10% down, there's even some jumbo loans that I've heard that are 5% down. Those, you could technically buy a house. They are set up differently, but most of the time, if you're gonna get a jumbo loan, you're gonna put 20% down. Basically between 10 and 20, but the majority of the time, people just put 20% down. Credit score has to be over 700 for the majority of lenders, and they are kind of, you know, strict. It just depends. It's a different experience by lenders. Some have different requirements, but some lenders are very flexible, some are not. It just really depends. But they all kind of carry the same guidelines, obviously. But it's a very custom product. So it allows financing for luxury homes. The rates are extremely competitive. What are the cons? Typically, they require a higher down payment and stricter requirements. Like the financials have to make sense, and also they're usually require more documentation. So these are the most common loan types. If you're looking to purchase a home, you most likely will go into one of these mortgages. There's also specialty non-traditional mortgages, but they're called like non-QM, and those are basically like the stated income loans, the bank statement loans. So like if you just started making a whole bunch of money online, there's special loans for you. So if you have a very unique situation, just go ahead and click the link down below. We actually just closed two loans from people who own their own businesses, and we just use their stated income basically loans, and they had to put, they require bigger down payments and stuff. But if you just made a whole bunch of money on the internet and you want to buy a house, we got a loan for you. So these are the most common ones. So now we're going to go into the most common expenses when you're buying a house. And typically there's four. There could be more, but the majority of the time when you are buying a house, these are your most common expenses. Number one is your down payment. So it can be 0 to 20%. I mean, you could put 50% down. 20% is not the maximum. You can really finance only 50% of the house, but you can put down as low as nothing, 0% down, depending on the mortgage that you're getting. We're going to go into and talk about a little bit about assistance for first-time home buyers. There's a ton of assistance. There are a bunch of banks that have different programs. There's different state programs. There's some that are just in the specific area. Some of them are income restricted. Some of them are not. There's a million ways to get assistance if you're a first-time home buyer. So go ahead and reach out, and we can point you in the right direction. So first expense is down payment. Second expense is typically inspections. Depending on the size of the home, the inspection can be anywhere between $350, $1,000, $2,000. If you buy a $10,000 square foot home, obviously the inspector's not going to charge you $350 because they're going to be there all day inspecting the home. But generally, it will be around $350 on the smaller houses. I would say to up to $600-$700 on the bigger homes, and typically it's by size. The bigger the home, the more you're going to spend. You can also do. We're gonna pause real quick and talk about what kind of inspections you can do. So you can do a regular inspection. You can do a sewer inspection. That's where you get a plumber to come out or inspector to come out and basically run a camera through the sewer line to make sure that the sewer line is cool. You can also get a mold inspection. You can do a lead paint inspection. You can test the house for lead. And this is just not for older homes. You can also do for things like, say, a house has an antique fireplace that was installed right, but it's a brand new house. You should probably test that fireplace for lead if it's like a very old one, right? You can also get the roof inspected, HVAC inspected. You can get the foundation inspected. There's all kinds of inspections you can do, and there's many of them. But inspections for the normal buyer, I would say, is between $350 and $700 that you're spending for inspections. Now the third expense is an appraisal. And this is where we were talking before, where the bank hires a third party, or technically you pay for the bank, so you hire a third party, and then they do what's called, and they put a value on the property. They do that for several reasons. Number one, to protect you, to make sure you're not paying more for the house that you're supposed to, and then also they're about to give you a whole bunch of money, so they want to make sure that their investment is covered as well. In case you don't pay, they can sell the house and make their money back. So that is generally around $500 to $650. That's what I've seen the majority of the time. It can vary against the lenders, but usually between $500 and $650. And then closing costs. What are closing costs? And we're going to go into deeper in a little bit. But closing costs can be about 3 to 6%. So when you're buying a house, especially in the state of Georgia, and I'm talking about the state of Georgia right now, and it can be different in your state, but the majority of your states are kind of like this. The buyer is responsible for the closing costs. You can negotiate with the seller to pay for closing costs, but it's typically going to be around 3 to 6% depending on the loan. And if you don't have a loan, actually, they can be like 1%, 2% if you're paying cash for a house. So that is the most common expenses when you're buying a house. The next expense that we got to talk about is the buyer agent compensation. You remember when I talked to you earlier about hiring an agent and signing a document? Well, this document is basically you hiring that agent to represent you on the purchase of the home. And in that document, in the state of Georgia, I'm speaking for the state of Georgia because this is where we sell real estate. It states that you will be responsible for the agent's compensation, basically their commission. So the agent's not working for free. And the majority of the time, and traditionally, the seller has paid the agent's compensation. But that document that you're signing basically states that the agent is working for compensation, and if the seller or the owner of the house doesn't pay them, you're responsible for that. This is another expense you also got to plan for because you don't know if the house you like, the seller is going to pay the compensation. There are certain situations that some houses that we have looked at that the owner of the home is only paying like a 1% compensation, right, to the buyer's agent. And if you sign an agreement that the agent pays 3%, 2.5%, whatever is on that agreement, right, that means that you will have to cover the difference. And that's something that a lot of buyers do not plan for. Typically, if you're working with a good agent, they will be able to negotiate that into the transaction so you don't have to cover it, but it is not guaranteed. Again, this is not guaranteed, and this is you're signing this document when you're working with an agent. So that could happen. And when you submit an offer, typically there'll be an exhibit talking about the compensation to the agent, and it's agreed upon basically as one of the terms of the offer. So go ahead and ask your agent about that when you're submitting an offer and say, is the seller paying buyer agent compensation on this one? Yes or no, and if they are, how much are they doing? So that you don't get surprised the day of closing that you have an additional fee because you're paying your agent. Now we're going to talk about closing costs, and this is for the state of Georgia. And I'm speaking, but the majority of your states kind of follow the same thing. In the state of Georgia, the buyer is responsible for the closing costs. But they can be negotiated that the seller can cover all of it, some of it, or or percentage, whatever, right? They can cover some. Usually the closing costs are about 3 to 6%. If you're getting a conventional loan, it's probably going to be around 3%. If you're getting an FHA loan, it's going to be around 6 probably. But sometimes it's less. The majority of the time actually is less. I always tell people plan anywhere between 3 to 4%. That's usually where it lands for most of the transactions that have worked with. For the majority of the people, it's usually around that. And if you're using conventional financing, the seller can only cover up to 3%. Up to 6, it depends on the loan, but the majority of the time it's up to 6, up to 3. I'm sorry. And then if you do an FHA, they can pretty much pay up to 6%. So what are closing costs? The cost of the loan. There's going to be like underwriting fees, processing fees on the lender side, just the cost of getting the loan. That's number one. Number two is the attorney fees. Basically, you are paying for the attorney to do the work, to do all the title work and the transfer, and all that costs money. Then there's also lenders and owners title insurance. The title insurance, if the lenders protects the lender in case you don't pay, and then the owner's title policy covers you in the event that there's like a title problem that happened before you purchase the house. This will basically protect you and give you clean title. If something were to happen, you will be protected. You will own your house. They'll take care of that. So I always recommend getting the owner's title policy because it is not required in the state of Georgia, but you always should get it because you never know what happened before and you don't want to get caught up going to court for something or something like that, right? So then there are recording fees. These are just the fees to record the deed with the county or state. Title search fees. There's also property taxes. You may or may not pay for property taxes depending on where you do it, but usually they're paid by escrow. There's transfer taxes too, which are just the taxes to that just to buy the house, right? There's taxes on that. Property taxes are basically the taxes for owning the property. There can be also city taxes depending on where you buy. And then there's so let's talk about property taxes, right? Say, for example, you buy the house the 15th, let's just say a date, June the 15th, right? The seller, the owner of the home, is going to be paying from January 1st, and they're going to be responsible up until the closing date, which is June 15th, right? And then you'll be responsible from June 15th to December 31st. And that's what, how you divide the property taxes. There's also like prepaid interest. And that is the interest that you're paying. Let's say, again, we're closing June 15th from the 15th to the end of that month. There's setting up the escrow account. That is where your bank pays for the property taxes and also the homeowner's insurance. And this is a special account that you pay into, so when the bill comes, the mortgage company would just go ahead and pay for the whole thing. And that's why in your monthly payment, you have a breakdown of like principal, interest, and then there's your escrow, which is your property taxes and insurance. So sometimes, and how much is that is very difficult to tell you. It depends on your credit and on the kind of loan, and there's a lot of scenarios, right? But sometimes you just have to, and when you close too. So sometimes you just have to pay 3 to 4 months into that account. Sometimes it's the whole thing. But that is basically the escrow, right? Also, the homeowner's insurance. Sometimes they ask for you to pay for the whole year up front. Sometimes just a portion of it. Again, the mortgage company pays for it. And then there's plenty of other fees. If you look at a settlement statement, there's a bunch of fees on there. And it's impossible to tell you everything. But that's usually closing costs. That is separate from your down payment. And again, the owner of the home or the seller can pay and help you pay for this. And that is closing costs. So this is a home buying process, very simplified, and I want to go ahead and make different videos going over everything in detail into more depth, because there's a lot more things. We kind of briefly went over everything, and the reason why I want to make this video, you should watch this video, is so you understand the process, because a lot of buyers, especially if it's the first time, or maybe you've done this a while ago, you still get questions, and there's still going to be more questions. Go ahead and leave those questions down in the comments. I'll try to answer as many as possible. But if you want to get a one-on-one consultation, click the link in the description, or go ahead and scan this QR code that's going to show up right here on the screen. And just fill out the information then, and somebody from our team is going to reach out. But thank you so much for watching. We'll see you guys on the next video. Go ahead and like and subscribe, and send this video to somebody that needs it. Thank you so much. My name's Fernando. We'll see you again.